Morning. What we're going to be looking at today is closing costs and settlement statements. All right. We're going to be looking at what are the fees or what does the seller pays and what does the buyer pay. What we're going to be doing is that we're going to be looking at a contract. We did a class a few weeks ago, a month ago, about contract as well, but we didn't go too much in depth about the fees. I just pretty much told you where to look at it. And today what we're going to do is that we are going to go a little bit deeper on these matters. Okay. So first we're going to see what the closing costs for the seller and buyers are. And as you can see right here, this is a regular as is contract. If you go to your page 126 of your contract, I'm sorry, line 126, I apologize, of your contract, section 9, it will show you here what are the closing costs paid by the seller and the closing costs paid by the buyer. All right. And what it does is that if you look at each one of these lines here, it will tell you where they are. For example, documentary stamps on the deed, owner's policy and charges, title charges, municipal lien search, homeowner association, condo association stopple fees, recording and other fees, etc. But I want you to notice is that on each one of these lines, you have a number, a letter, and an I. The same thing here, a 9, a C, and 3 I's, and a 9, a C, 1 I, or 3 I's if checked. What is that referring to? All right, you will see the same thing here with the buyers, 9, 3, 2 I's, and also you see where our compliance fee is added here. Now, let me explain this to you what it is. And we've seen this a couple of months ago when we did the other class, is that depending on what you check, if you check seller shall designate closing agent and pay for owner's policy and charges, if you check this one, that's the one little I, if you see right there. If you check number 2 over here with the 2 I's, buyer shall designate closing agent and pay for owner's policy and charges for closing services related to buyer's lender's policy. And then the third one is the 3 little I's over here. It says Miami-Dade regional provision. Seller shall furnish a copy of the prior owner's policy of title insurance, other evidence of title and pay fees, a continuation or update of such title evidence which is acceptable to buyer's title insurance underwriter for reissue coverage. All right. Let's go and dissect this real quick. You went ahead and you selected, let's say in this case, you selected B, right? I always tell you guys, do not select B, even though in today's market it's not a bad idea, because if you select B versus this one here, the number 3, you select number 2 versus 3. Number 2 is going to pay for some of the seller charges that are customary for the seller to pay. So in today's market, it might be beneficial if the other agent knows that, hey, his client, the seller, is going to save some money, right? Because let's go up and see if you select this one, what would happen over here. Let's see the seller cost, the buyer cost over here. If you selected the number 2, he will pay for the policy and charges, all right? And over here, with the seller normal fees that you see up here, right? Let's see what would the buyer pay in this case. Right, I'm trying to see, I don't see nothing here. I don't see number 2, all right? But then you see here that that's how you need to look into it. You got number 3 here, you got 1, you got a 3, you got a 1 here, and you see other ones here. But what are the buyer's cost? We got here that he'll pay for owner's policy, and also he will pay for the municipal lien search. You see that here? That's normally a fee that the seller pays. All right. Remember that the seller, as per contract, has to give you clean title, and the title company is going to do the job of searching and requesting that municipal lien search or estoppel letters, right? But in this case, if you selected number 2 here in the contract, that buyer is going to pay, he will pay also for municipal lien search, which normally is a seller fee. So if you select the number 3 over here, right, you'll see what is that the buyer is going to pay, all right, and what the seller is going to pay as well. So you go to the seller, he's going to pay for the municipal lien search. Now you see here that the seller is paying for the municipal lien search. Either if you pick 1 or 3, he's paying for it. But once again, if you pick number 2, your client, the buyer, is going to pay for the municipal lien search. Make sense? So it's always good to find out and learn these selections of your contract to find out who is going to pay what. All right. In this case, if this is normally in Palm Beach, the seller shall designate closing agent and pay for the owner's policy and charges, and buyers shall pay for the premium for buyer's lender's policy and charges for closing services related to the lender's policy. Pretty much the seller's picking up the tab of the title insurance for the buyer. All right. And now remember, even though I said it's customary, it is not required, it's not the law, it is not something that has to happen when your client, the buyer, might be buying a property in Palm Beach, or your client, the seller, has to pick number I, the first one. It is not an obligation, it's not the law, it's just customary. So everything is negotiable. You can either pick either of these 3. It does not make, it's not the law. So once again, if your buyer is buying in Palm Beach and they want to use Casalina Title and Escrow, which happens often, you just pick the Miami-Dade provision. Probably the realtor in Palm Beach say, no, we got, with the seller picks in Palm Beach. Well, guess what? It is not the law. It's negotiable. As a matter of fact, you know, in this case, his client would be saving the title insurance policy, right? But once again, this is very important that you always know what are the fees that your clients will be paying based on the selection you chose. All right.
Cesar, quick question.
Yes.
So usually we always pick number 3, the Miami-Dade Broward Regional Provision, right?
Yeah.
How is it common that the seller actually does furnish the copy of the owner's policy, or do they end up just buying a whole new owner's policy?
That's a really good question. In that sense, it doesn't make a difference for the title company if they get a prior or not in the cost, because what happens is it only protects the title insurance company, because what they do, let's say that your client received a title policy from the purchase date of the seller, all right, when he had a policy. So that what happens is that the new title company will come and get a new policy from the date of closing to that date that the policy that the seller gave you, right? It's like a gap. It just covers the gap, right? But for the cost or the process, it doesn't make a difference at all to the title company. And most likely, the title company is going to want to do their own search regardless of that prior policy. Does that make sense?
Yeah, but is it a savings for the buyer? Will it end up being a saving, or really, like, no. If the seller were to provide the owner's policy and then he just gets a continuation, would it be less expensive for the? No, it would be the same thing.
The same. The only thing is that removes some risk to the underwriter, the title insurance company, because something happens when that seller owned the property for that period of time. We can go after their policy. So the insurance company that's giving you the new policy can go after their policy because they were covered at that time, versus having to use the new policy. So for the underwriter, it's beneficial. It's less risk, but it's the same cost. Doesn't make a difference at all. Anybody else got any more questions before we move forward? All right. So let's go ahead, guys. What I'm going to teach you now is something. It's called calculating your seller proceeds. A lot of you guys, or a lot of realtors go, and we get a listing, and we aren't able to tell our clients how much money they're going to have left over after they sell the property. And sometimes what people tend to do is that they call the title company for an estimate. And the title company can't really give you an estimate. The title company can only give you an estimate of their fees and whatever they might pay for taxes. But that amount is also something that anybody can get just by Googling it. How much is going to be the taxes on the sale of my house on with the county, right? I'm not talking about capital gains. I'm not talking about taxes to the IRS. I'm talking about property taxes. I mean, recording fees and transfer taxes to the county, right? So a lot of people do not know how to calculate and give their clients an estimate of the proceeds. So we have a form that you have also on Form Simplicity, and is there for you. And this is the form I'm going to share with you right now for you to take a look at. And I put this form last night on the group, all right? If you go ahead and open your form, you want to go with me and do this together, we can do this at the same time if you want to do that. But this is something that you as a professional, as a consultant, you should know you should be able to respond to your seller and give him an answer of how much money he's going to receive if he sells the property at such price. All right. And also, if you notice that this form over here in the bottom explains to you what the cost is. All right. So if you don't know it by heart, you just come over here to the bottom and you'll be able to see each one of those detailed lines. Okay. So I'm going to teach you how to do this real quick. All right. Here, obviously, I suggest that you always present it to your clients. You put the seller's name, the property address, your phone number, right? Here, what you do is that you come and you put a sales price. Let's say $300,000, right? All right, you got $300,000. And then over here, your client owes $150,000 on their mortgage. Always, when you meet with your client, ask him for the most recent mortgage statements. Now, remember that the amount and the balance that shows on the mortgage statement is not the payoff. The payoff can even be a little bit more than the amount shown in the statement, right? So always say it's an estimate, and that we always must get a payoff prior to closing, okay, to be able to have this number be more exact, right? But it's always an estimate. Remember, it's only an estimate, but always get that information either from them, right? Or get it from their mortgage statement, which is the best source you can get, right? So once you do that, so let's assume that your client's property is paying, just to make an easy number, right? His taxes are $1,200 a year, which is $100 a month. You get the listing today. Today is May 7th. If he sells the house today, he's going to have to give a credit to the buyer of 5 months of taxes, right? So let's say your client closes today, May, he's going to have to give a credit to the seller, to the buyer, I'm sorry, for May 1st from January 1st to May 7th, I'm sorry. Makes sense? Why? Taxes are paid. When are taxes paid? They're paid on November. They are due in November, right? And they're paying arrears. So the owner, if they sell the house on June 1st, they have to give that credit back to the buyer from January 1st to June 1st. If they close on July 7th, they would have to give a credit to the buyer from January 1st to July 7th. Does that make sense, everybody? Thumbs up. Are you with me? All right. Why? Because when November comes, the buyer has to pay those taxes, right? So he needs to collect that at closing from the seller, right? So let's assume once again that the taxes are $100 a month, okay? You list today the property, May 7th, okay? And you list the property May 7th. So how many taxes will you tell your client on this estimate? I suggest you do 11 months, the full year taxes. Why? Because the listing is for 6 months. Okay. So normally today's market will sell faster, but because your listing is for 6 months, you do the number of months that have passed by, which is 5 from January to May, plus 6. All right. That's 11 months. So the total amount you want to put here, if the taxes are $100 per month, you put the full amount of $1,200. Okay. So those $1,200 now he needs to pay at closing $151,000 because he owes 150 and he owes 151,000, $1,200, which equals 151,200. All right. If we subtract the 300,000 minus the 151,200, now his balance is 148,800. Okay. But now let's add all the cost. If you're charging your client 6% commission, all right. So let's say $150,000 times 6%, that equals $9,000. All right. If you're charging 5%, or you're charging whatever percentage, you change it here, right? Lien search, we notice here something you need to see here real quick is that what is the maximum? It says over here for title search is the maximum is $200, right? If you select the Miami-Dade provision, if you're going to select down the contract, you're going to put that the lien search is going to be 150, right? But the title search, you can put up to $200 that we've seen in the contract. I don't know if you're seeing that. Let me go back, move this quick. You see this here? What says over here, $200? Okay. For an abstract continuation, right? So the lien search is the fee that is paid to the city. The lien search will cover how much they owe on water, if they have any core violations, if they have any dues owed to the city, everything that's related to the municipal or the city is a charge, is a document. It's called the municipal lien search that they provide to the title company. That has a cost. Average is $150. Okay. And that's the fee that your client is going to pay at closing. It could be $200, it could be $250, depending on the city, but normally an average is $150. Then you put our compliance fee or broker only commission fee, a estoppel letter if they live in a condominium, right? And they live in a condo, then the title company needs to get an estoppel letter. And what's an estoppel letter? An estoppel letter is a document that pretty much says if the owner, how much he owes, is he has any violations, is any special assessments, is there any what the monthly assessment is, if there's any restrictions, right? This document, the title company also will send to the association, and obviously the association will not do it for free, okay? And I'll have David send you over an estoppel letter and also a copy of municipal lien search. You can take a look at it. Well, these two documents.
If the owner requests the estoppel on his own, can he save that money or no?
It's not recommended they do that because you don't know the owner, right? He may lie. He may do a document that he may alter the document. He may have a violation that he owes $10,000, or there's a special assessment and he lied, and you use that document. The same thing with the payoff. Normally, us as title companies, we don't want to allow them to get their own payoff because anybody can make any changes to those documents, right? So it's better that the title company, whoever you're dealing with, they do it and they are held responsible for any mistake, not you. So if you give that document to the title company, pretty much, the seller could just leave. You can't find him no more. They're going to come after you. Okay. So always have the title company do that instead. Right. And most associations, if your client has a deal with the association, he's part of the board of members or he knows somebody there, they can still waive the fee for him, but that document has come directly from the association. Okay. So the abstract and title search, that's a search that the title company does that I show you in the document that shows maximum $200. And pretty much that's a document that we as the title company, we see all the documents that have been recorded on title for the last 30 years of the existence of that property. And that's how we're able to analyze and be able to provide you with a title insurance policy, right? And that's a document the title company also orders, all right? Settlement fee ranges, depends on the company. We charge $650, you know. That's our normal fee, settlement fee for the title company. And also documentary stamps. Documentary stamps for the seller, okay, is very easy, guys. And remember that information is in the bottom as well, these documents. So let's say this is the easiest way to do it, okay? Let's say this for $300,000. You divide that by 100, right? Which is going to come down to $3,000. And you multiply that by 0.70. That equals $2,100. That is the transfer tax that your client is going to pay to the county. Okay? It's 70 cents per $100 or $7 per thousand that he pays. 70 cents per 100 or $7 per thousand of the selling price. That's a transfer tax that you pay to the county. Okay. Same thing as Palm Beach. I mean, it's pretty much all Florida. It's pretty much the same. Right. And that's $2,100. All right. Very easy, guys. And once again, you should find it down here in the bottom. 70 cents, I see on line 58, 70 cents per 100. All right. And I always narrow that up to the nearest 100 if necessary. Recording fee of his deed is roughly around $10. I always put $50. But there's something I always do. I always put here $500 miscellaneous other fee. Okay, just in case. I prefer to overestimate and make my client at closing be happy because he got more money than I told him, than versus at closing him receiving less money. Okay. Now remember that all these fees are customary. All these fees are already given by the state of Florida, like the recording fees, the transfer taxes fees, the settlement fee. They're pretty much standard in the industry. You're not going to find a settlement fee for a company that is $650, another company is $2,000. So you are able, knowing these numbers, you're able to provide this to your clients, right? This is something that you need to know as a professional consultant, real estate financial consultant. You need to know and tell your client, hey, if you sell this property at this price, you're going to get this amount of money. I had cases and instances that the realtor never told the client how much money they're going to get. And at closing, they come and they're surprised with the number they're going to receive. And guess what? It becomes a big issue. They come out, would have sold my property for more money than I did, and I wouldn't know this. I don't want to pay this. And guess what? These fees, they have to be paid. I mean, unfortunately, there's nothing you can do, I mean, to waive these fees. I mean, if you waive any fee, what is going to be waived? $300, $200? Is that going to make a change or a difference this man's, proceeds? No. We're talking about thousands of dollars. So it's very important that you get always those documents from them. All right. You find out what the stop fee is. Also, let them know that it's not your fee. Let them know there's a condo fee that it may change. All right. Let them know also that the lien search, it depends on the city. There's an amount that you calculate. That's roughly an estimate. And it's also an average of what the people charge, the cities charge. So it's not something that you are charging them. Your fee is your commission and the $349. Okay. You cannot make a mistake on that. All right. Also, remember that when your client sells, if he has an escrow account, when you see that mortgage statement, you tell him, hey, John, Peter, whatever his name is, you have an escrow account. You have an escrow right now, $6,000. Okay. Once you sell, you're going to get that money back. Okay. Don't forget that. because that's added income or added money in their pocket at closing or after closing. Okay. So always look into their mortgage statement because that escrow, it belongs to them. So let's say their insurance to be renewed on November and they close it on May, they probably have 7 months of insurance saved already. And they probably have 7 months of taxes saved already, right? If the taxes and insurance is $100 a month, they got already their $1,400. Okay, they're gonna get back at close after closing, after they close. All right, guys. Any questions on this before we move forward?
Yeah, Cesar, how soon will they receive that escrow check? Or do they have to request it? What's the timing on that one?
Yeah, it's a very good question as well. It's like 30 days or 60 days, depending on the bank. But I suggest that you tell your client, hey, after closing and after the bank gets their money, their wire for the mortgage being paid off, give them a call and tell them what it is your forwarding address. You don't want them to send that check to the address where they used to live at, right? So these are things that you have to, it shows that you know what's, you know your work, you know your business, you know what you're doing. Tell them, hey, call the bank after the mortgage is paid, give it 3 days after closing, give them your foreign address so he can send you your check. Right? Good question, Rene. Anything else, guys, before we move forward? Man, you guys are good. All right, guys. So once again, this document, I placed it on WhatsApp on the group chat. I hope you were following with us and filling it out yourself too. But once again, if you have any questions, just give us a call. We'd be more than happy to help you with this, okay? But it's very, very easy. Okay, next thing we're doing now. Let me close this. All right. We use the calculating seller's proceeds, and now we're going to look at settlement statements, okay? There's two types of settlement statements. One is the closing disclosure, which is the CD. The other one is the American Land Title Association, also known as ALTA form, okay? The CD, we used to have the HUD. Yeah, we used to call it the HUD, right? And in 2015, they changed it to the closing disclosure, the CD. So it's very different from what we used to use before. But now the ALTA is very similar to the HUD, right? The ALTA is normally used only when the mortgage company, the lender, or the attorney representing a seller or buyer wants the title agent to sign the same document. Because the closing disclosure has no field or space for the title company or title agent to sign. But the ALTA form, it does. And sometimes the bank wants the title agent to sign the document or the attorney representing either buyer or the seller for the title agent to sign it as well. So it's very common. But let's look first at the closing disclosure. The closing disclosure compared to what it was last time, they added a lot of stuff to it, right? I believe it added good things. I believe it also made it kind of confusing. But I think is that, I think it's good that you need to learn what this document looks like, and you need to be able to explain it to your clients. So as you can see, pretty much on the first page, it pretty much has the property address. It has the title company name, the type of loan, the loan ID number, who is the lender, right? The loan amount, the interest rate, the principal and interest payment, okay? It tells you if it has a prepayment penalty or not. Also tells you if it has a balloon payment. And it also gives you the breakdown of the reserves or escrows that you got to pay. So this case, this one has a mortgage insurance of $100 and an estimated escrow of $765. So what it's telling you right now that your total payment is going to be this amount here, $26.96. That's including the 1800 here and the 2696 here. This is pretty good because back in the days when we started a file at closing, the buyer's first question is, "What? How much is my payment going to be?" Right? And you had to go and look for the whole package. You got to look for the note, and the note was on a page 90, 97. And by the time you found that page, 10, 15 minutes have passed. But now it's in the first page expressing what your rate is, what your payment is going to be, and what your escrows are going to be as well. But also keep in mind that this payment here does not show the HOA dues or condo dues. Okay? You don't see that here in this part here, right? Very good, guys. Let's move on. Shows your closing cost.
Right there, Cesar, where it says years 8 through 30, is it because the mortgage insurance falls out? Why are they no longer including it in years 8 through 30?
That's a good question. It has the same number, as you can see there, but it says amount can increase over time. You see that? Because taxes can go up and insurance can go up. Make sense? It's giving you estimated escrow, what you're going to pay today for taxes, mortgage insurance, taxes, right? And insurance. But it's letting you know also that this amount could change. Could change anytime. Actually, they just put a between 1 and 7, between 8 and 30, but that amount could change. Now, your mortgage insurance, you know, you can remove that once you pay 20% or more from the principal balance, or when your property has gone up in price, 20% or more. So that you can eliminate that mortgage insurance.
Except if it's an FHA loan.
This is unless it's an FHA loan. FHA. It remains there for the term and life of the loan. Okay. So that's a good question. Good observation. Man, you're active today, Renee. I like it. So yeah, the payment can increase, right? Taxes are going up every year. It's crazy. Insurance is going up every single year. A lot. So yeah, I mean, these can change every time. The only thing that will never change for the terminal loan is this amount here. Your principal and interest payment. That is fixed for 30 years if you get a 30-year loan. Okay? All right? So here, once again, tells you your closing cost. Right? And it tells you your cash to close. How much this person had to bring at closing. This includes the down payment and closing costs altogether. All right?
Question.
Yes, sir.
Going back to what you said about the PMI. You said unless if it's FHA, it says for the life of it.
That's correct.
Otherwise, it's something 80, what is it, 80% loan to value?
Only conventional.
Oh, so even if it's FHA, even though your what do you call it?
Your value went up.
Yeah, your value went up and all that. It will not change it if you ask for that?
No, it won't.
Okay.
Yeah, it won't. Before it used to, but now they made it mandatory for the term of the loan. So now when you're putting a big down payment, 10, 15%, whatever it is, you don't want to go FHA, right? But if you have low scores, you don't have too much money, it's a hard loan. FHA is more flexible. So that's why people go FHA. But yeah, mortgage insurance, just to stick to that point, mortgage insurance on FHA is for the life of the loan. Conventional, when you reach 80% loan to value or your home has increased by 20% more, right? So once again, closing costs and cash to close right there. Now, normally what we do at closings that we never start on the first page. Where we start on the first, second page. And here is going to give you in detail the cost for the borrower, okay, for the buyer. It will also express the seller cost. Now, that's not mandatory to have both charges in the same document. Sometimes the seller may say, hey, I don't want the buyer to know how much money I'm making. And that you can have a separate CD for the seller. Okay. That happens a lot. Some people are just, they don't need to know how much money I'm making on my house. It's none of their business, right? So I don't want them to see my proceeds, right? So the seller may be in a different CD. In this case, we have them both, right? We're only going to focus today on the buyer side, okay? But here you see on every section where you see this black frame right there, it will tell you what the cost is for, okay? So let's see the first part, loan cost. This guy got charged $428 only for that loan, okay? No, so you see there's no lender fees, there's nothing else. It's just a 428 because we had to extend the rate. They had to pay that $428. And then we have, see here, Bauer Services did not shop for. These are services that he didn't shop for, that he can't shop for. He cannot select his own appraiser. He cannot select his own credit company or credit retrieval company in this case. So these are fees that they get charged, but he cannot shop for. So the first fee, you see here, the 465 is on the right-hand column because it was paid before closing. It was paid outside closing. The appraisal is paid in advance, right? That's a fee. But also the credit report now is charged at closing. The flood cert is charged at closing. And that tax service is charged at closing as well. These are items related to the loan in which the buyer or the borrower cannot shop for. All right.
Cesar, what's tax service? What does that mean?
The tax service fee is a service. You see CoreLogic here. That's a company that they collect those escrows and they make the payments every year on behalf of the bank. So they have a setup fee of $79. Okay. Oh, $85. I'm sorry. All right. Now, services borrower did shop for. These are services the borrower can shop for. He can shop for a different title company. He can shop for a surveying company. That's services the borrower has the right to shop for. So the survey fee, you see $350, courier fee $45, electronic fee $49. Endorsements, these are related to the insurance, the lender's coverage, the settlement fee, and the title search, $200. On this side, you can see the buyer's fees, right? That means the seller's fees, I apologize. And here, the buyer's fees, right? So what we've seen here is that these are the closing costs. A lot of people say, what are my closing costs? And everybody thinks that the closing cost is this full amount. And technically, it's not. It's not the full amount. But we say, what's going to be my total closing cost? If you want to be really technical, this buyer's closing cost was $4,700, including the appraisal, right? Those are the closing costs, right? But in the world out here, everybody, the buyer, the seller, say, what are my closing costs going to be? We add everything in one package, right? They don't understand this separate fees and different things like we see in here. We're going to see other costs, right? We're going to see now that these are the costs which are related to taxes and government fees. Recording fees for the buyer, $190. E-recording, $9. Transfer taxes, intangible tax, mortgage tax. These are fees are paid by the buyer. And here's over here what the seller paid, which is that 70 cents per hundred. Okay. Remember we looked at the seller's proceeds? This is right here what he's paying. Here the buyer pays a total of 55 cents per hundred of the mortgage amount, right? The tangible tax is 20 cents, but the transfer tax is 35 cents, right? Added both of them are 55 cents, all right? So if you get the loan amount, you divide it by 100, multiply it by 55, you adding these two is going to give you that number, okay? Here is the selling price that the seller's paying. is 70 cents per 100. So selling price divided by 100 multiplied by 0.70 is going to be this amount. All right. Now, prepaids. Let's look at prepaids. These are items that have to be paid in advance, okay, by the buyer. One of the items that have to pay in advance is the insurance, the homeowner's insurance policy. They got to pay that 1 year in advance, right? Another thing they have to pay in advance is the prepaid interest. So you see this person closed on April 26th, and the lender charging for the 26th to the 1st of May, right? Let's say the closing happened on April 2nd. The lender is going to charge him from the 2nd of April to May 1st. If they close on the 28th of April, they're going to charge him for the 28th to the 1st of May. Why? Because the lender doesn't give you nothing for free. The lender at closing is already giving the money to the buyer, right? So the lender is going to charge for those days in advance. He's not. So let's say it's 20 days, right? Imagine 20 days times per day is $38.05. That'll be $671, right? The lender is not going to give the buyer a free ride and lose $761. Imagine how many millions of dollars they will lose if they don't do that, right? So by seeing this here, the client here paid $38.05 per day, which is the interest they pay per day on the loan, which equals $190.24, right? This, when you see this here, you can tell right away that the first payment is going to be June 1st. This client first payment is going to be June 1st. Why? June 1st payment is to cover for the month of May. Okay? Because you pay the interest in arrears. When you use a credit card and you go to buy something, you only pay that interest next month. The same thing here. You need to let the interest be accrued for the lender to charge you for that interest that you did not pay for that month. Make sense? All right.
Yeah.
Okay. All right. So let's move on. Then over here, the lender is also asking for a reserve, right? Normally for homeowners insurance, they're going to ask you for 4 months of reserves. 4 months of reserves equals per month. She's paying $320 a month for the insurance times 4 equals this amount. All right. And then they're going to ask for, in this case, 8 months of reserves, which the property tax a month is $444.74, which equals this amount here. Okay. Why do they need reserves?
Sir, that's my question. Is that negotiable with the lender, or that's set on stone, the number of months?
No, that is not negotiable at all. Okay. That is not negotiable at all, because what happens, let's say that this client, let's use this client for an example, right? She closed on April 26th. Okay. Let's say that the bank only collects 2 months, or let's say she didn't collect no taxes. All right. The client's first payment is going to be June 1st. All right. So June 1st, the first payment, the 2nd July, the 3rd August, the 4th September, the 5th October, the 6th November, right? What's going to happen is that November, she needs to pay those taxes. And the bank isn't going to have the money because they only collected how much? They only collected 6 months. They only collected 6 months of taxes, correct? What's going to happen? The bank's going to call her and say, "Hey, I need 6 months. I need to pay the full year. I need you to send me another 6 months." The bank doesn't want to do that, because what happens if the buyer doesn't have the money? when they got to pay the taxes, right? That's a big risk for the lender. The lender's going to have to pay them because they do not want the government to be first priority over the lien, right? So in this case, November comes, she already paid 6 months of those reserves, I'm sorry, correct? Plus 8 months. So the bank has, right? They have 14 months of taxes by November 1st, correct? They pay the full year and they still got 2 months in reserves. And once again, the whole saving starts all over again. So that is why it's non-negotiable, Rene. All right. The same thing with insurance. They need to have a reserve on the insurance because they don't know what the insurance is going to be next year. Okay. If the insurance is going to be, you know, higher or lower, they do not want to call the buyer or the borrower in this case and ask him for money. They don't want that. Okay. So they want to make sure they have enough money. Okay. So now here you're seeing the aggregate adjustment. Don't ask me how to calculate that. Is a formula. They see how many months are left over with this and that. To me, it doesn't make sense, but that's how it works. They get a credit. They figured out that they're probably taking too much money at closing, and instead of taking all that money to their calculations, they give a credit back to the buyer. All right. Any questions so far, guys? Anybody else before we move forward? Guys, let me encourage you to make questions, okay? I mean, it's okay if you don't know something, ask. It's a perfect environment and perfect opportunity to do that. All right. Let me go on over here. Here's the buyer's transaction fee or commission fee, commission only fee, which, by the way, when you get your HUDs or your CDs, I'm sorry, you always want to check that here it says commission only fee. Okay. So $395. Here's I represented the seller. Even though I did the loan for this buyer, I represented the seller. Here's the fee, $349, right? Here's the stopper letter that we spoke about, right? M&M Management Property, $250, right? You see Casina Title and Escrow here because we paid up front that fee already. We are getting reimbursed. Municipal lien search, okay? It was charged to the buyer. I don't know why, but $175. Oh yeah, because they selected number 2 of the contract. That's why it was charged to the buyer. If they were selected Miami-Dade division, it would have been here on this side. Okay. Now the commissions, right? The title insurance. And what we see now is that all this here, right? All from here, all the way down here equals this amount. All right. But if you see as we went through each section, like this, and this is added, and is added up here, the total amount. This, and this is added and is placed over here above. So as you go down, you look up. All right. So here is $10,000, $425 of other cost, right? Plus the closing costs that we have over here. Those two amounts equals this amount here. Plus the appraisal that he paid outside closing equals this amount here. Make sense? Pretty cool, right?
Yeah.
All right. Any questions before we move forward? Awesome. I like Melina's thumbs up. All right, let's move on. All right, here, guys, this is very important. In 2000, before 2015, when we had the market crash on 2008, 9, they came with this new document and this new law. The new law is that whenever the lender gives a consumer a loan estimate, right? Whatever was disclosed to the consumer has a 0% tolerance on lender fees and government fees. So if the lender said, okay, that his loan origination fees were going to be $1,000, and at closing he charges $1,500, then the consumer gets a credit back of $500. If the lender made a mistake in calculating the transfer taxes and said it was $1,000 and they charged $2,000 at closing, the lender has to give back the money to the consumer. Okay? So, in essence, lenders do not make any more mistakes. Because what used to happen in the past is, unfortunately, there was a lot of people, unscrupulous people, that, or unprofessional, that told the client, hey, you're going to need to bring at closing $10,000. The client shows up at closing, and he looks at the settlement statement, and he needs $15,000, right? What happens is that then the buyer is all stressed out, right? Is just, when I'm going to get $5,000 more, he probably doesn't have the money. And guess what? They had to find the money because they already had the dreams in the house. They already packed everything on a U-Haul. They're ready to move. They're already vested, right? But guess what? It always left a bad taste on the mouth of those buyers, a bad buying experience. This is something that is good because this way there's no surprises, right? And if there's a mistake, then somebody got to pay for it. Why should the consumer pay for it? Correct? So when you see here on the left column, this is the loan estimate I gave the client, right? I gave him an estimate of $16,000, $657, but the total cost was $15,181, right? So I overestimated, which is better than underestimate, right? And then I didn't disclose this $465 in the beginning because this fee was charged because we had to relock the loan. Our rate had expired and we had to relock it, and there was a change in pricing, right? Excuse me? So,
So you had to cover those. So who covered that cost? The lender?
no, that was not a lender cost anymore because it was something that was out of my control.
Oh, okay.
Okay, that was that what that does is a change of circumstances. And that change of circumstances allows you to make those changes. It wasn't because I didn't disclose right. It's because the rate was expired and we had to relock.
Oh, okay. Like the rate fluctuated and they needed to lock it, so they had to pay the cost to lock the rate.
Yes, because the rate changed, right? We locked at 3.375, but that same rate, because expired, had a cost now of $465. Okay. So then you see here the down payment. All right, the down payment here that she came in with, the final down payment, then a deposit, her deposit, adjustments and credits, and the final here. So I told her she had to bring $57,000 and she only brought $50,000. Would that be a happy buyer?
Yeah, for sure, man.
Right? Why? Because I told her I got an application 3 days later, I gave her the loan estimate, and I said, you need $57,000. Perfect, Caesar, no problem. She comes at closing and she only needs $50,000. It's $7,000 difference, right? So, happy client. I save her money, right? So this is all the last section. This is a summary of the transaction, a summary of everything we've seen up here. It's just a summary, right, of everything.
Caesar, but the question is, why was it overestimated by 7,000? Like, where was the?
I don't know. I have to look at my estimate, but could have been the insurance, right? Could have been I don't know. Could be a lot of things. I don't know. I can't tell you exactly what it was, but what I have to go back and look at my loan estimate. Exactly what's the difference on all these fees? Where did I come back different, right?
Yeah.
So something that we do loans here in the office that we don't charge fees, right? We don't have any, processing fee or underwriting fee. We don't have those. As you can see here, there's nothing here, right? There's only that relock fee that we had to charge. So if I had underwriting fee or something like that in the loan estimate, and then it was waived because we didn't charge it, that makes a difference as well, right?
Yeah.
So I couldn't tell exactly what it was. I'll have to look at the loan estimate that I gave her and compare apples with apples, see each one of them, right? So here, let's look over here now, the summary of the transaction for the buyer and the seller. So the sales price 462, right? We see that this number carries out here as well to the seller as well, because here's a cost and here's a credit. And then we see the cost of $14,000 that we've seen above. And now we have to see an assessment of the homeowners association. She's paying the buyer, she's paying the seller because the seller already paid the month of April. She's given him a credit back from 26th of April to the 30th of $26. And also a net value in taxes of $219.33. But because this is a cost to the buyer and it's a credit to the seller, it transfers to this side. You see that? All these numbers transfer exactly to this side. Here's a cost to the buyer, but is a cost is a credit to the seller. The buyer has to pay $462,000. The buyer has to pay $26,000. The buyer has to pay $219. All right, which it becomes a credit to the seller. So the buyer's cost is $427,000, but the seller's credit, okay, is $462,245. Okay, what we see over here in the top. Okay, so total cost, I'm sorry, here, total cost and total credit to the buyer, to the seller. Make sense? There's always above, all right? So let's look now. We've seen the cost of the buyer. Now let's look the credits for the buyer, right? She gave a $10,000 deposit, boom, and she's getting a new loan amount of $415,800, and also the seller. Remember the seller proceeds, the taxes prorations. The seller is giving her a credit from January 1st to the 21st. I'm sorry, January 1st to April 25th of $1,477. That is a credit to the buyer. If we add these three amounts equals this amount over here, right? So now we see the total cost from the seller minus the total credit that we seen just a second ago. This is the amount of money she had to bring at closing. Make sense? Now let's do the same thing for the seller. The seller has a total credit of $462,245. Now let's look at his cost. All right, $23,000 in closing costs that we've seen from the previous page. He needs to pay a loan of $226,000. He has a mortgage of $226,000, and also he had a second loan of $9,000. And also because he's paying from January 1st to April 25th to the buyer, credit is $1,477. So that total cost with the mortgage and tax and prorations to the seller is $260. $510.27. You see it here. So the total credit minus the cost, that's how much money he made. $201,000.
Plus what he gets back from escrow.
That's what he gets, plus, exactly, plus whatever he gets back on escrow. Right? Now, real quick, I'm not going to go through this next document, and I'll share these with you. This is the Alta form. Is very similar to what we used to have at the HUD, but it shows everything in just simple numbers. It no longer what the payment is, what the interest is, none of that stuff. It just shows credit and expenses for each party, right? So you see it here again. Due from buyer, 49. Due to seller, 201. You see that? It's the same document, it's just a different format. And it's called the Alta form. Okay. All right, guys. I got probably like 2 more minutes. We got another appointment to go. Do you have any questions before I let you guys go? I love it.